You're listening to LendIt Radio, episode 95. This is a recording of the Credit Junction company demo. It was recorded at the LendIt conference in New York, 2015.
On where we fit into the landscape that is now evolving in and around us. So, the Credit Junction is a tech-enabled online platform focused on small and mid-sized businesses, primarily within the manufacturing, distribution, and supplier spaces. It's always good to sort of lay out up front how we're different than the companies that, such like On Deck and Funding Circle, etc. So we are first to market with a true ABL product, so we look at things from an asset-based lending platform, kind of holistic approach. We do loans from $200,000 to $2 million, so loans are of size and scale that is different within the small business space. We both have revolver and term structures. So while there's a lot of term structures out there, we are one of the first to roll out a revolver kind of structure to look at the small businesses. And we use data and technology both pre-origination as well as when you think about an asset-based lending, kind of mantra, post-origination and monitoring. And really the mission is to transform how SMEs finance working capital. Like I said, when you look at the space, and if you steal a master's analogy from the weekend, from golf, to the left are really a lot of the traditional small business marketplace lenders out there that are looking at sub $250,000 loans, very sort of cash flow oriented kinds of structures and evaluative credit models. And to the right are your traditional asset-based lenders, specialty lenders. They traditionally don't go below $2 million in loan size because it's not efficient to really do so. We sit in the middle. So, like I said, we offer loans from $200,000 to $2 million. They're collateralized. So there's UCC1s against receivables, inventory, equipment, the whole nine. We have a hybrid tech-enabled manual approach to looking at credit, and we can actually go from application to funding in less than 14 days for up to $2 million. So this is a pretty traditional slide that you'll see lots of check marks on the left, so I won't go into it, but it really tries to show where we sit in this ecosystem that is now developing in and around small business lending. And the mindset of the Credit Junction has always been that there is a big network of small businesses that need this $200,000 to $2 million. Where are they going to go to get it now that the traditional financial institution landscape has changed? That's how the Credit Junction was born, and that's how we have grown the company to today. So when you look at the borrower perspective, and you see lots of industrial pictures up here, because really a lot of our companies come out of those manufacturing, industrial kinds of spaces, whether it's aerospace, defense, general manufacturing, construction, oil and gas, and if you think about the supply chains within those kinds of areas, you can understand the collateralized nature and how that would be an attractive market for us to go after. We offer two products. So, I think a big differentiator is the revolver kind of product, which really looks at, like I said, the working capital holistically and tries to look at borrowers' inventory and receivable needs, optimizing what we call this cash-to-cash cycle. A lot of these small businesses within industrial and manufacturing and distribution kinds of spaces have a unique quality from the fact that they have inventory, they have cash tied up on the inventory floor or in transit, they're waiting on payments to come in from their receivables, and there's been a lot of press, and the New York Times actually did a piece recently how multinationals are unilaterally pushing out these payment terms. So how is a really good small business going to adapt to that when they have this cash-to-cash cycle problem? And we try to offer a solution in a revolver interest-only capacity such that we match their borrowing base to a set of criteria. And as long as they don't fall below that, we're not going to take principal. That principal can be used and generated further into the growth of the company. So it's really proven us quite different in the market. And then obviously we have, a traditional term kind of structure, which is mainly for equipment. So, there are equipment companies that need, fresh $500,000 by equipment. That's easy to sort of match a term structure. But when a borrower comes in, we really try to use a flexible kind of analysis to look at them and say which of these products matches best. And like I said, we use data both pre, but more importantly, I think post, and that's quite different than what we're seeing out there, where we have a lot of data coming in from our borrowers every week and every month in and around the asset side of their company, so we can understand how they're progressing through the life cycle of the loan. From a lender perspective, just sort of high level, 200,000 to 2 million, rates of 9 to 19%. So we're clearly more expensive than the depository institutions, but less than it would take a factor to factor your receivables, and that's been attractive. Medium duration, 6 to 24 months, and is really product driven. So quite frankly, the term is different than the revolver, and we look at it in a medium duration kind of capacity. And then finally, just a little bit about us. We are a collection of executives in and around the space from a technology standpoint, financial services, public policy. We've all come out of everything from GE Capital to the U.S. financial services community. So that's us in a nutshell. I sort of sped through it because I wanted to leave some time for Q&A. Is there any questions? Yes, sir. Okay, that's a lot.
What was that question? I'm sorry.
You can ask.
What size of portfolio you have, who are your lenders, and what's the investor structure?
Yeah, so we launched the platform in January, so we just onboarded our first few loans. So numbers are still in the single digits, but we plan on obviously escalating that forward. The capital structure of the company, so GLI Finance led a seed round in September into the company and is providing the initial capital. And as the company grows, we'll be bringing on institutional-only kinds of capital providers. Any other questions? Yes?
What origination channels?
Yeah, that's the key to it all, isn't it? I think as an originator, cost of acquisition is going to be the defining characteristic for all of us. So I think when you look at, I'll say this, and I think we don't do a lot of the traditional kinds of small business customer acquisition that is out there right now, because our loan size warrants a little more of a high-touch model. So when you look at the spaces we're in, lots of industrial manufacturing, it lends itself to a high-touch model in and around local and initiatives that may not be the direct mail of it. Any other questions, comments, concerns? No? Yeah.
One over here.
Oh, then I'll get you.
Can you briefly describe your underwriting structure and plans and thoughts around that?
Sure. The underwriting structure is run by a gentleman that's come out of GE Capital. So we take a very much an asset-based look at the model. So someone will come in, they'll give us some preliminary data. We will look at it, and we can basically get to a good place within 5 to 7 days. So we've taken the best of both worlds, and this is what I was trying to sort of articulate on the golf analogy. We've taken the best of data and underwriting with a manual ABL approach. We will never get all the way there through a technological solution. But if we can get to the 20-yard line immediately, we create a lot of efficiency in the up to $2 million loan market. And I think that's the goal. There was another question, sir.
Just to follow on to that,
Yeah.
Where can you use technology to sort of accelerate that process or make it more efficient?
It's a good thing my CTO is sitting in the front row right here, so he can probably talk to you afterwards directly, but I'll give you a broad space. I think from the technology standpoint on the post-origination, the ability to gather data on a weekly and monthly basis from borrowers and not have to have a human evaluate where a borrowing base ends up is something that we are very focused on. A lot of times these ABL shops will have to evaluate these borrowing bases manually. So they get paper forms in, they look at where the receivables are, every single receivable, and they evaluate based on a borrowing base metric. We're looking at making that completely seamless from end to end. So that's just one example, but like I said, if you have any other questions, we can answer them directly. Did you have one? Do we have time? One more?
What's your take on distribution and attracting borrowers to the platform?
I'm sorry?
What's your take on distribution and attracting borrowers to the platform? So can you comment on that?
Yeah, I think you know, when you look out there, these borrowers are in an interesting space, right? Because they have a great business, but their cash is sort of tied up. So our ability to get to them through various, what I'll call offline channels. Because if you look at the manufacturers and suppliers and distributors in and around these spaces, they all sort of congregate in certain areas, and they're all sort of in and around the same kinds of offline structure. That's where really our focus on the customer acquisition. Did I answer your question? So, On Deck, I don't know, I can't speak to On Deck, great company, I can't speak to their customer acquisition.
All right, I think that's all the time we have, so everyone please thank the Credit Junction.
Thank you very much.